Pierre says, what is your best income strategy and why? Well, you've heard me talk about it a lot over the last few years, several years. Pure income strategy I've been using most over the past 5.5, 6 years is bull put credit spreads. I've been using the 2-week out bull put credit spread positions based on the criteria that we tested and analyzed, Pierre, the weekly bull put default search. It looks for positions that are 10 to 14 days out in time. Usually I'd run the search on Monday for the next 2 Fridays expirations, but this is what I look for. So on Monday, I might open positions. Now, Pierre, I was on cycle, Pierre, to open new positions this week, and I didn't. Why? Because of what happened on Monday. And the market pulled down because the Evergrande Chinese Lehman Brothers, or Bear Stearns counterpart there, were going to default. I believe they defaulted last night, if I'm not mistaken. They didn't make their payment. I think they owed $83.5 million to banks off of something like a $300 billion loan. Does that sound right? Or billion debt? I think it's that. So the loan was $83.5 million that was due Thursday, and they didn't pay it. And the company hasn't said anything yet, as far as I know. This was as of about 3 o'clock this afternoon. In any case, you saw what the market did on September 20th, and it recovered after that over the next couple of days, went back to where it was, our stocks, the US stocks, before that fall. But it sent a panic shockwave through. So thankfully, what I normally do is open this strategy in the afternoon, Pierre. 1, 2 o'clock in the afternoon, I look to open the positions, the top 3 that match my criteria here. I'll do the research on each one and then decide which 3, 4 I'm going to trade. But because of that movement, I waited. And I didn't see what I liked on Wednesday for any possible positions, so I'm just going to wait another 2 days. And on Monday, following Monday, 3 days away, I'll be looking at these positions in a sense, but the 8th of October expiration, which will be 11 days out on Monday, for positions usually average around a 15% return on the bull put credit spreads with about an 87-88% success rate over time. There's other things I have to do to follow the rules, keep the losses to a minimum, follow the trading plan to close those positions. Yeah, usually don't take a loss of more than about 45 or 50% of the maximum risk on the position, Pierre. That 12 or 13 times we have to close a position. This is what has worked best for me over the last 5.5, 6 years. Ernie and one of the other gentleman, Mike Phillips, that worked with us a while back, he was running and evaluating Iron Condor positions up until about 2015, 2016. I stopped trading Iron Condors around that time because the market turned. And the market started to show that pattern of lower left to upper right, and it continued with some hiccups, obviously, Pierre, over time. It looked to me as if we were going forward on some of those larger positions, and the graph over that time period, Pierre, was lower left to upper right, probably would have been fixing or managing the bear call side of the Iron Condor 40, 50% of the time, and it wouldn't have been as profitable as it had been the following years. So I stopped doing Iron Condors, and Ernie did too. I didn't even use them as a management technique for a bull put credit spread if the bull put side started to get threatened, because of what the market was just doing over that time period. Now, a lot of discussion you've heard about covered calls, naked puts. We've got a question for Ben coming up on covered calls in just a moment as well. These is not to say that these weren't successful positions during that 6.5, 7-year time period I'm talking about, 5.5, 6 years I'm talking about. Yeah, we know that we've had the big hiccups in the middle. We know that we've had those issues there. But what we're looking at here is this is right about the start of that bullish run that we've seen. And yeah, there's discussion that maybe we are deeply overextended at this time. Starting around the end of 2016, beginning of 2017. The hiccup here, I can tell you exactly what that was. I was in 3 bull puts in that position, and all 3 closed for about a 50% loss of the max loss in the position. 3 days later, they were at 100% loss. That's February 8th through 9th, 2018. I'm sorry, February 5th through 9th, 2018, the start of the China discussion, China trade wars. And there was another hiccup later on in August of that year. And then we went back up. This was that disastrous October, November, December. So In some of these periods, you're having to manage the bear call side on an Iron Condor, especially here. Now you got to manage the bull put side. Now you got to manage the bull put side. Now you got to manage the bear call side. Now you stop trading bull puts right about here. Okay, another rule that we follow, Kip, I'll get to that in a moment. And then the rise here. Iron Condors were getting killed on the bear call side. So bullish positions were working. And you have these massive drawdowns where you usually take a step back. The other day, I was in a cycle to trade. Take a step back. Wait, get a better sentiment, and then go forward, Pierre. What else would have worked during this time frame? A lot of what our investors are asking about. Covered calls until they don't work. Cash secured naked puts till they don't work. Buying straddles and strangles on just SPY as part of the portfolio would have worked. Not selling, buying in those cases. For me, the bull put has worked well, and we've been fine-tuning the criteria that we use, right about here. Actually, no, I apologize. Here, I had it nailed down to exactly what I wanted and was showing me historically and moving forward in real markets, everything that I wanted. You don't trade it consistently. You follow certain patterns, and when they don't match what you want, you don't trade during that cycle. You take a break. But yes, covered calls would have worked. Naked puts would have worked as income strategies as well. Just they're more capital intensive. And I prefer personally, with that portion of my portfolio, the 50 to 60% or so, that's capital intensive, such as covered calls or full cash secured naked puts, Pierre, I prefer to use married puts, longer term trades on growth stocks with the guaranteed limited loss of only 4, 5, 6% in the worst case scenario, where the proper structure that we describe in the blueprint, the full work that discusses our approach to the married put technique and 12 different income methods that we can use against it, the 5 or 6% is the worst case scenario. And I'm going out 180, 190, 200 days out in time. So that means in the first 30 days, even if the stock falls 5 or 10%, I can get out with only a 1 or 2% loss because of the time value, the opposite effect of what we just talked about for Salvatore. When I buy a put that's 6 to 8 months out in time, I'm on the other edge of that time decay curve, where in the first 5 or 6 months, we don't suddenly see a lot of change in the time value decay for the far out put. It's in these last 60 days. So even in the first 30 or 40 days, even if the stock falls 5%, I'm still keeping most of the time value I paid into that put option because it still has a long time to go. And also, I may do a standard collar position as opposed to a covered call or naked put. A collar is, you buy the stock, you sell an at or out of the money call like you would with a covered call, but then you buy an out of the money put. So that gives you sort of this hockey stick graph, but with a top. And that's a 20 to 30 day out trade, just like a covered call or naked put would be, because the insurance is placed. You're looking to make maybe 2.5% on the upside without risking more than 4.5% to the downside. It's a protected position that's shorter term, and I like doing that better than taking the risk on some of the cash secured covered calls and naked puts. Bull call debits would have worked well. Why didn't I really include that if it is a parity trade there, Pierre, to a bull put credit spread? The vertical spreads, they're parity trades of one another. Well, it's a different approach with the bull put credit spread, where I'm selling an I'm selling an out of the money put with a high probability of expiring worthless and buying a lower strike for a net credit. On the bull call debit spread, you're selling a call and buying a call. You might do it in the money for the higher probability of success. A lot of investors like to go at the money to have only a 1-to-1 risk reward ratio. Most of the bull puts I look for are 6-to-1, 7-to-1 risk reward ratio. We're risking, $2.20 to make 30 cents in that case. So that's about a 7-to-1 risk reward ratio. But that's the nature of high probability spread positions. I didn't mention bull call debit spreads, even though they would have worked over the last several years as well, provided that when you saw the markets change, Pierre, you would have gotten out of the positions and not entered into a new cycle. But you said income. Debit spreads are a good strategy, but you're not getting income right away. That could be a semantic discussion in this case, Pierre. But you're paying a debit to get into the position with the hope of closing it out for the gain that you want later on. We don't refer to that as an income strategy directly because you're not taking income in as when you sell a covered call, sell a cash secured naked put, sell a bull put credit spread or a bear call credit spread if you're more bearish on the position. You're not taking credit in. You're paying credit out. Right. So I prefer married puts with that portion of my portfolio, 50 to 60%, that's capital intensive because of the known risk. The put is not a decaying asset. It's actually a second working asset in my favor, done correctly, following the rules in the blueprint. And I have 12 different ways to adjust the position, pay for that risk to where I end up having a bulletproof position. I have one right now in Ally Financial. I sold a call the other day. It got me to bulletproof status. The put's still out to January. In that case, I have a January 55 put, sold the October 55 call. The stock's at 52. That canceled the remaining risk on my position. So I have a bulletproof position. I can't lose any money on it. It's guaranteed profit of 2% in that case, and it can still continue to go up. So that's with the larger portion of my portfolio. Not to say covered calls are bad. I just prefer to do this. A lot of investors, Ernie does naked puts and covered calls as well as doing the married put positions. The two strategies I like to use to income Pierre are bull put credit spreads, which I've talked about, and sometimes calendar call spreads, or what investors sometimes call the poor man's covered call. On stocks I can't trade as a married put that I like. Let's say Netflix. Let's say Domino's Pizza at I think $385 per share now. Things of that nature, higher price stocks. Rather than do a married put or even a covered call, what I'm going to do is buy an in-the-money call that's 5 to 6 months out in time, and then sell a near-term call against it. So I might only be paying $20, $30, or $40 for the call instead of $385 for the stock, and I'm still selling the at or slightly out of the money call against it to get at a $1, $2, $3, $4 against the cost basis of the leverage loan call. Those are my preferred strategies. And I'm not saying that I am, by any stretch of the imagination, the best trader in this room or the most profitable trader in this room or in the world. I would never say that, Pierre. What I'm saying is these are the strategies that I am most comfortable with. And for income directly, it's typically the bull put credit or the diagonal calendar call or poor man's covered call position. That's what works best for me. I haven't done Iron Condors in so long because of the nature of the market over the last 5.5, 6 years. And bear call credit spreads did not perform as well as bull put credit spreads over the same exact time. Okay. So I stuck with the direction of the market, and for income directly in, calendar calls and bull put credits. I could consider the married puts income, but I don't do it right away. We wait for the stock to move up in order to do that as well. On the discussion with Pierre, Chuck asks, I'm curious if you do bull put credit spreads on inverse ETFs. I try to be neutral to use such bull puts to achieve that goal. It works for me. That's great, Chuck. To answer your question, no, I've never done it. I have never done a credit spread on an inverse ETF when the market turns. And I think you know why. And this is a great little example. It doesn't relate to Ben's question, and it doesn't relate to the follow-up question that we just had from Salvatore. But let's take a look here. We talk a lot, Chuck, about when the market turns. You've heard me say this the past few weeks, that when the market turns, my approach is to lighten up on the bull positions I have, lighten up on the calendar calls and the bull puts, maybe skip a cycle as I did this week with the bull put credits because I didn't like the action on Monday or what it might point to later in the week. Plus, after Monday's event on September 20th, what do we know we had coming up this week? Turned out a little bit opposite of what I thought, but we knew that Fed announcement was coming out when they were going to discuss when they were going to start tapering off the asset buying and when they were looking to increase the interest rates. And I think they're going to taper off the asset buying, the US Fed, in mid-2022. And I think they were projecting their first start of rate hikes were going to start again in 2023. The market appeared to like that because it really jumped Wednesday afternoon after that announcement was made. We talk about protection against the unknown, protection against the black swan, stock or portfolio insurance, Kip, as you know. And what did we see on Monday? Let's just go to a 1-month chart for the VIX. And this was the same for SPY, similar for SPY puts, QQQs, or trying to say for me on Monday, hey, let me shift from opening bull put credit spreads on stocks that I know are performing in the trends that I want. Let me just switch now. Instead of doing bear calls, let me go into bull puts on inverse ETFs. I know you're going out of the money there too, and you're keeping that same cycle. But this is what we always discuss, isn't it? When a move happens in the market, here's your Monday, September 20th. When a move happens in the market and you've got a VIX hedge, SPY puts, or you decide, hey, I'm going to switch now and I'm going to go to bear call credit spreads, or I'm going to do bull puts on an inverse ETF in this case. But VIX or UVXY shares or puts on SPY, puts on SPY, there we go. The move happened on September 20th. It happened 2 days later. It was right back to where it was. And it was lower 2 days after that. So there's Monday. Wednesday, you're back to almost break even from where you originally started from, perhaps right over here, buying VIX calls as a hedge across the market. And then here, you're back to normal. I thought about opening bull puts these last 2 days, but I'm going to wait till Monday to keep my cycle and to keep my trading plan. Why am I going through this, Chuck? This enforces the discussion you have had, you have mentioned to me, others have, Jim has mentioned to me. I believe Kip even discussed this with us as well. We talked about it and you guys shared your thoughts. If you have a hedge in place to cover against a black swan event and the move happens, you typically want to sell at least half, if not a little bit more, of your hedge that jump. And then maybe sell half the next day, half of what you have left, and then get out of the rest of it. Because normally when you see these spikes, it's a 2 or 3 day course. Recently, the past 8 months, 9 months, that's what they've been. So if I have puts in SPY, if I have calls in the VIX, or I have a hedge, when those events happen, I want to start closing that hedge and taking the profit on that hedge in the first couple of days after the first movement. Let's go 1 year here on the VIX. So typically, you can see it here. I know this is kind of truncated. VIX spike here lasts about 8 or 9 days, and then it was right back to normal. This was a longer one. This was 1 to 2 days. This was 2 to 3 days. This is about 4 days, and then it was right back to where it was, right back to where it was. This spike here was 4 days. Well, it was 2 days, a break, and then 4 days, and then back lower than where it was. 2 days, 2.5, 2 days of a spike back to normal, then another 2 days, then back below normal. Okay, so the calls would have only been profitable here and here. You got to get out of those positions. Here's the 2 days we just looked at. Here's 3 days. Here's 2 days. Right back to normal. Okay, so when you have that kind of hedge in place, you've got to close it quickly because it normally only lasts for 2 to 3 days. Exception, as we talked about last week in our discussion for John, we were talking about the naked puts in a down market, is that September 2020 decline happened over 3.5 week period. In that case, you would invest to stay in the puts, of course, for that whole time period. And that's what we wanted to emphasize there, because you have to have an exit. Thank you, Kip. You have to have an exit strategy with the hedge. It's not just to hedge your portfolio, which is great, but you also have to have a trading plan and management technique for the hedge as well, so you don't risk losing why you had the hedge in place in the first place.